The Buffett Indicator just screamed strongly overvalued for 2026, hitting $69.15 trillion in total market cap against GDP. Forget the AI hype and easy money, this isn't just a red flag, it's a giant crimson billboard. Warren Buffett himself called this the best single measure of market valuations, and right now, it looks eerily like 2000 or 2008. If historical patterns hold, this indicator has a chilling track record of warning about impending market tops. So, with central banks easing globally and everyone feeling optimistic, what does this 2026 red flash actually mean for someone with investments right now? Let's dive into the math and the history. The total U.S. stock market is currently valued at an eye-watering $69.15 trillion. That's more than double the entire U.S. economy, reaching an insane 222% of our GDP. To put that in perspective, even during the dot-com bubble peak in 2000, the same metric, famously known as the Buffett Indicator, didn't climb quite this high. In fact, as of March 31, 2026, it's flashing a stark, strongly overvalued signal. Warren Buffett himself, in a 2001 Fortune interview, called this ratio probably the best single measure of where valuations stand at any given moment. And right now, it's screaming caution. Despite widespread optimism, fueled by easing financial conditions, central banks lowering rates globally, and the relentless hype around AI adoption, history tells us these are precisely the times when the market can be most vulnerable. You see, global financial conditions have eased dramatically, credit spreads have tightened, and corporate earnings are broadly up. It feels good, right? Almost too good. The lesson here is that market euphoria often masks underlying risks that only become clear in hindsight. We're going to dive into what this Buffett indicator actually means, how it's calculated, and what historical precedents it shares with past market tops. This isn't about predicting the future with a crystal ball, but rather understanding the historical signals that could offer insights for someone managing their portfolio in this environment. So, what exactly is this Buffett indicator that's got everyone talking? And why does it matter so profoundly to market analysts? At its core, it's a macroeconomic ratio, elegantly simple yet deeply insightful. It meticulously compares the total market capitalization of all publicly traded U.S. stocks, a figure often tracked by the Wilshire 5000 Total Market Index, to the country's gross domestic product, GDP. Think of it as a grand economic snapshot. How much is our collective stock market wealth valued compared to the sum total of goods and services our entire economy produces in a year? Warren Buffett himself, the legendary Oracle of Omaha and chairman of Berkshire Hathaway, was unequivocally clear about its significance. In his seminal 2001 interview with Fortune magazine, he didn't just mention it, he declared it probably the best single measure of where market valuations genuinely stand at any given moment. The true power of the Buffett indicator isn't in forecasting daily fluctuations or quarterly earnings surprises, it's a robust, long-term valuation barometer. Historically, a fair value for this indicator hovers around 100%, implying the total market value of all stocks is roughly equivalent to our annual economic output. When this ratio deviates significantly from that equilibrium, particularly on the upside, it often signals an extreme condition. For instance, consider the dot-com bubble's zenith in March 2000, when the indicator soared past 180%, acting as a flashing red warning before the ensuing market correction decimated tech valuations. More recently, when economists Dr. Alan Sagariv and Dr. Jana Kane published their updated analysis on April 2, 2026, they reiterated its fundamental purpose: to clearly illustrate whether the stock market is becoming overextended and potentially detached from the underlying strength of the real economy. It's a simple yet undeniably powerful gauge. Which brings us to the absolutely shocking 2026 readings. So, this leads us to the big question. What exactly are these 2026 readings telling us? As of March 31, 2026, the Buffett indicator is not just hinting at trouble, it's definitively flashing red alert and signaling strongly overvalued. This isn't a subtle shift, but a dramatic ascent. Think of it like a speedometer buried deep in the red zone. By January 25, 2026, the indicator had already soared to an insane range of 220% to 222%, and it held firm at around 219% by the end of March. Let's break down those numbers for March 31st, 2026, precisely. We're looking at a total U.S. stock market value of an astronomical $69.15 trillion, placed against an annualized GDP of $31.57 trillion. When you do the math, that's how we hit that 219% figure. The real kicker? This current reading unequivocally exceeds the peak we saw during the infamous dot-com bubble in 2000. That's right, the valuations we're seeing now are even more stretched than they were right before that bubble burst. It's no wonder that on April 20, 2026, Fortune senior writer Cheryl Estrada reported that this closely watched valuation gauge is indeed flashing a warning. She wasn't mincing words, and the data backs her up. For someone examining the current market, this extreme overvaluation demands careful consideration. The lesson here is that when this indicator is this elevated, historical precedent suggests potential challenges ahead. This brings us to behind the bubble. What's driving these valuations? So, what's behind this strongly overvalued signal in 2026? It's not just one factor, but a perfect storm of global conditions. We've seen a massive surge across global financial markets, fueled by significantly easier financial conditions. Think about it. Central banks in virtually every major country have been lowering interest rates. This isn't just a minor tweak, it's a powerful propellant for strong global stock markets, tightening credit spreads and making borrowing cheaper. A huge part of this current exuberance is the seemingly insatiable optimism surrounding artificial intelligence adoption. Many investors are placing big bets on the transformative power of AI, driving up valuations for companies positioned to benefit. We've seen specific stocks like Nvidia, with its ticker Nvidia, skyrocket as investors project massive future earnings. It's a bit reminiscent of the internet boom in the late 90s, where future potential often outpaced present reality. Beyond AI, the global economic picture looks surprisingly robust. China, for example, along with other major overseas economies, has shown remarkable resilience. Couple that with decelerating inflation across most countries, and you have conditions that sustain global growth, providing a seemingly solid backdrop for earnings growth. The lesson here is that while these conditions, lower rates, AI optimism, and broad-based earnings, are generally positive, they've collectively propelled the stock market's valuation far beyond the underlying growth in our gross domestic product. It's like having a car with an amazing engine, but the speedometer is stuck at 200 miles per hour while the actual speed is 80 miles per hour. This brings us to the crucial part. Decoding what flashing red actually means for someone in your situation. So, what does it mean when the Buffett indicator is flashing red and signaling strongly overvalued in early 2026? It's crucial to understand that this isn't a direct prediction of an immediate market crash, nor is it a timing mechanism for selling everything tomorrow. Instead, it's akin to a severe warning light on your investment dashboard. It indicates profound potential trouble ahead, suggesting a significant, possibly unsustainable, disconnect between current stock prices and the economy's underlying earning power. Historically, such elevated readings have often preceded periods of considerably lower future returns, prolonged bear markets, or even significant market corrections. Consider this. As of March 31, 2026, with the total U.S. stock market value reaching an astronomical $69.15 trillion against a GDP projection of $31.1 trillion, this indicator is screaming that valuations are stretched to extreme levels. Warren Buffett himself, in a seminal 2001 Fortune magazine interview with Carol Loomis, famously called this probably the best single measure of where valuations stand at any given moment, adding with characteristic prescience that current levels feel like playing with fire. Back in the dot-com bubble of 1999 to 2000, the indicator climbed to an unprecedented 180%, and the subsequent fallout, notably the Nasdaq's 78% decline, was severe. Now, as Private Wealth noted on January 25, 2026, the sentiment among seasoned analysts like Dr. Jeremy Siegel is that alarm bells should be ringing for investors, urging extreme caution. Reaching an unprecedented 222% indicates a market distortion that even surpasses the dot-com bubble peak and the 2008 financial crisis in relative terms. The lesson here is that when the market's perceived value outpaces the actual economic output by such a wide margin, the risk profile significantly increases, demanding a strategic re-evaluation of portfolios. Understanding how to navigate such a market is key. So, what do we do when the Buffett Indicator, updated by Alan Sagarev and reviewed by Jana Kane, is screaming strongly overvalued as of March 31, 2026? This isn't about panic selling, but a prompt to re-evaluate. It suggests taking a hard look at portfolios, particularly for overexposure to highly valued assets, especially those riding the AI hype wave that has been a significant driver of broad-based earnings growth. Imagine a portfolio heavily weighted in 2000 towards .com stocks. That kind of concentration, without fundamental support, becomes a serious vulnerability. For someone in your situation, this flashing red light highlights the importance of diversification. Perhaps it's time to consider increasing cash positions, or investing in less correlated assets as a defensive strategy. When the total U.S. stock market value sits at a staggering $69.15 trillion, and the Buffett Indicator hits 222% as it did on January 25, 2026, it's a strong signal to prioritize company fundamentals, earnings, debt, actual cash flow, over mere broad market momentum. The lesson here is to shift focus from speculation to value. Remember, increased volatility is a real possibility when valuations are stretched this far. Having a long-term investment plan that accounts for market cycles, rather than chasing every immediate gain, becomes paramount. It's about understanding your personal risk tolerance and adjusting strategies to protect capital. In early 2026, with global financial conditions significantly eased due to central bank rate cuts, the market is undeniably buoyant. But as Warren Buffett himself noted in 2001, this indicator is probably the best single measure of where valuations stand. So, when the Buffett Indicator hits these extreme levels, as it has in early 2026, it's not a cue to rush for the exits or make any sudden, drastic moves. What it truly means is that the historical odds of above-average returns in the short to medium term are significantly diminished, and the potential for a substantial drawdown has increased. The lesson here is about preparation, not prediction. It's about understanding the environment we're investing in, recognizing the math of potential returns when valuations are stretched this thin, and adjusting our strategies to build resilience into our portfolios. Have you ever seen the Buffett Indicator flash red before and navigated a subsequent market correction? Share your experience in the comments below. Did you adjust your portfolio, or did you ride it out? I'd love to hear your story. And if you want to keep getting these data-driven insights to help you make smarter financial decisions, make sure you hit that subscribe button. If you found this breakdown valuable, you'll definitely want to watch my deep dive into how Ray Dalio's all-weather portfolio is structured to withstand these kinds of strongly overvalued market conditions. It's the perfect next step for understanding how to adapt.